My name is Jillian Fairley, and I am the General Manager of the Center for Business and Economic Development. And I'm a member of an Ask an Expert Planning Committee. The Planning Committee and Ask an Expert series is led by the County of Simcoe, and thanks to their leadership, we're able to bring organizations throughout the county some excellent content as we navigate the current environment. I would encourage you to keep an eye out for future webinars. Also, thank you to the regional partners who have assisted with these webinars. And of course, that includes the County of Simcoe, but also the Small Business Center of Barrie, Simcoe County and Orillia, the South Georgian Bay Small Business Enterprise Center, the Orillia CDC, Nottawasaga Futures, North Simcoe Community Futures Development Corporation, and our organization, the Center for Business and Economic Development. And we have some people working with us in the background today, and I want to thank Jamie and Karen for their help. You'll be muted for the duration of the call, but please use the chat feature to ask questions. Prior to today, several of you shared questions in advance, and these have been provided to our expert presenter, and many of them have been incorporated into the presentation today. And our generous presenter has also offered to put together an info sheet to address the questions that could not be answered in today's session, and that will be circulated following the webinar. We're also hoping to have a few questions or a few minutes at the end for questions and answers. So if you have questions during the session, please type those questions into the chat function, and you will find the chat button at the bottom of your screen. We ask that you address the chat to all panelists and participants so we can see your questions. And we will address as many questions as we can at the end of the presentation. It is my pleasure to welcome our presenter today, Alan Lloyd from Lloyd Management Services. Alan started his own consulting accounting business in 1985 and then later accepted a position as an outreach coordinator or resource officer for the Canada Revenue Agency. He has an in-depth background in full tax services as well as tax recovery from CRA, and a passion for helping small businesses either take off or stay on the right track. This session will help you learn important information for managing financials for your business and meeting your tax obligations, as well as tips and tools and where to find those important resources. It is my pleasure to hand it over to Alan. Thank you, Alan.
Thank you, Jillian. Good morning, everyone. Pleased to be here. I'm just going to set up the screen for you. Didn't do that correctly. Here we go. All right, so good morning again. Pleased to be here with you. This is obviously very important information, especially for sole proprietors or business owners. We will touch on both sole proprietors, partnerships, and corporations. However, we have incorporated, due to the plentiful benefits that came due to COVID, coming from the government, and how do we treat these. So we will deal with those as well. We'll discuss those, and so stay tuned. Here we go. Let's skip the first screen here. Here we go. Okay, so that's not. There we go. This will be the information that we're going to cover. We're going to try to complete this agenda, as well as including the COVID-related benefits. Again, as Jillian mentioned, I spent some time answering the questions, so you will get a written file regards the questions that you've had. So if we don't touch on it in this session, those answers will be in that file that they will share at the end of the session. All right, so we already know who I am, so let's move on. Let's first look at the business structure that is typical here in Canada, and that's a sole proprietor, where you are the owner, you absorb 100% of the liability, then at the same time you get to enjoy 100% of the profits. Whereas a partnership is very similar to a sole proprietorship. However, you have more than one working together, so two or more. Interesting thing about a partnership is that each partner, regardless of the percentage of ownership, is 100% liable for any actions of the business. So keep that in mind. Keep that in mind when you choose your partner. Now, the incorporation is under the tax law, is considered a person. So it is a separate person. So therefore, you are working for the corporation that you've created. So the corporation, though, does not have a voice, does not have a means to act on its own. So it depends on its directors and shareholders to direct it. Therefore, there can be some liability on directors and shareholders. Again, we can't go into too much length on it, but it's something that you should recognize, is that incorporating does not completely absolve you of all liability, but it does limit some. So remembering it is a separate legal entity, therefore you would have to treat it like as though you were working with another person, right? So a very clear visibility would help in managing the corporation. The question that came up quite a few times in the list that I received was expenses. How do we treat expenses? How do we look at these things? I would prefer starting off with understanding what the purpose of an expense is. Oh, I skipped a slide. I apologize. This is a little bit more about the corporate structure of a business and some of the benefits. And so, for example, it is considered to be more legitimate and long-standing. Creditors and investors feel more comfortable working, lending, and or investing in a corporation. When you're planning, if you are near retirement, for example, and you've got a good business, you might want to pass this business down to your children or someone else. Well, a corporation allows you to do that by just changing directors and shareholders, instead of having the purchaser or the one receiving the business having to go through the whole registration process again. So this is important to understand in an estate planning. Incorporating a business allows for that continuity without all of the paperwork. And as I mentioned before, directors and shareholders can be held liable. Okay, now we're going to go to the expenses. This is where it gets more exciting. So the purpose of the expense. So I've had questions in the past and again today that relate to, well, what expenses can I claim? Well, that list would be exhaustive, because we need to look at the expense as more as a principle. And the principle of the expense is, what does the expense serve in the business? Does it serve you to earn income through that business? If so, that expense is reasonable. All right, so for some businesses, having a coffee machine, for example, wouldn't be appropriate. They're alone, they work alone, or perhaps they go on site. They could be working in some trades where they don't have clients coming to their office. So it wouldn't be appropriate to have a coffee machine and all these kind of things. But then you look at a legal office, a dental office, and they may have these type of hospitality equipment. So again, it's the purpose of the expense was to serve your clients, then to also earn income through the business. So thinking of the expense, remember this principle, that the expense should allow you to earn income through a business. As well, it's an expense that you otherwise probably would not have incurred personally, okay? For example, you could pick up laptops today for $500. But if you're in the business of working on computers, with computers, whether it's accounting or IT, you certainly wouldn't buy a $500 computer. You might spend $25,000 or $3,000 for it. That justifies the serving the business again. right? So again, looking at the reasonability as well helps us to appreciate what expense could we include in our business structure and our business books due to the fact that it serves our business in the best way possible. So again, principle, the purpose of the expense is to earn income in a business. Retention of receipts. About 4 years ago, I believe it was 4 years ago, I always need to look this up, but the CRA did amend their policy with regards to original receipts. Now, it does suggest, or it's clear, not suggest, but it's clear that you must have the original receipts, not only the credit card statements or bank statements, but the receipts to reconcile with those statements. All right, so the statement alone is not an eligible receipt. It only proves that you paid for something. So the receipt is important, but here's where they made the change. They made the change and they added that you can digitize these receipts and destroy the hard copies. As long as you digitize them, you have the original receipts. Okay, so something to keep in mind as we manage working in smaller spaces and don't necessarily have the room for all of these boxes and such. Many, of course, start up a business by operating from their home. And that's obviously an allowable expense, and it's reasonable, as you are not required then to have a commercial lease somewhere where it would most likely cost you 3 to 4 times the cost of operating out of your home. But the use of your home, again, is restricted to the actual space that has been exclusively set aside for business, right? So you've removed personal use from a portion of your home. So you've maybe dedicated a bedroom. That is the space that's not considered shared, it's considered business. And because of that, you can claim that portion. And the easiest and most effective way of determining that is really measuring the area and determining what the square footage that is being used overall compared to the square footage of the home. All right, so everything can be included in here. Now I'm going to add something that occurred for this year and is considered allowable for this year. And this is the personal use of your home to operate as an employee. That was one of the questions. The only difference between the two is that as a business, you can deduct the interest on your mortgage, whereas an employee, you cannot deduct the interest on a mortgage. Okay, so pretty well all the other expenses to operate the home are allowable at a percentage that reflects the use. However, for an employee, they're restricted to, or they're not allowed to claim the interest on the mortgage. We will discuss this a little bit further because for employees that had to temporarily work from home, there's also a simplified method that you'll be able to look up and use, which allows a maximum of $400 as a tax credit. Bookkeeping. Again, many of the questions related to, the structure of your books and records. I want to encourage you to develop books and records, to set it up in a way that you understand it. All right. I may have many opinions as to what they should look like. A professional bookkeeper will have opinions as to what it should look like. However, you need to understand it, because bookkeeping is a tool for the owners, and therefore that tool needs to be understandable. Okay. So the bookkeeping, we will look into a structure that I believe is most common, and then you'll be able to see how to perhaps structure if you're going to be using an Excel spreadsheet or something more sophisticated like QuickBooks or other software programs that track your bookkeeping. But bookkeeping, again, is an essential part of managing your business. You cannot manage your business without knowing what it's doing. So the question that I would have out to you is, what does good bookkeeping serve you? How does it serve you? Where does it serve you? Well, I've heard answers like, well, if the CRA comes knocking and wants to review or audit your books and records, if your books and records are in good order, and there might be a few mistakes, the CRA will most likely ask you to make these adjustments, but no penalties will ensue. But poor bookkeeping will obviously frustrate the auditor. They'll have to spend countless amount of hours to try to restructure your bookkeeping, and whatever they find, they will hold accountable. So it's keeping good bookkeeping shows that you exercise your due diligence as to the representation you have. So what the CRA, the policy that the CRA maintains is that your books and records should clearly indicate who your clients are, where the income, where these sales or income came from, and what related expenses were claimed to earn that income. So there should be some formatting of type. But again, they're not too restrictive on the formatting. Again, that's more on you, the business owner, to determine a process or a matter, a format that works for you. Excuse me. And finally, we're going to look at how it applies to income tax and HST. But we first need to look at a profit and loss statement or an income and expense statement. Interchangeable words, they mean the same thing. So let's have a look at the profit and loss and a balance sheet. So the profit and loss basically describes or identifies that you actually have a pulse. The business is operating. There's some sales. There's some expenses being incurred. It shows what's happening in the business. And then the balance sheet reconciles all of that information to determine whether or not this business is actually viable. And we'll look at how that can be described and how it can be read from looking at financials. So this is a common profit and loss statement. In the questions, there were, one of the questions was, how do you report your business income to the government? Well, for sole proprietorships and partnerships, they would use something similar to what you see here on your screen. Yet, the CRA has created their own template, and the form is the form number that you might want to jot down, but it's also in the notes that you're going to receive later. A T, as in Thomas, 2125. And that is the profit and loss statement that will guide you through absolutely every step of representing and declaring the income and expenses in a business. It goes right through discussing the use of your home, as well as use of vehicles, so that it really leaves nothing to guess. It's clear, it's concise, it's complete. So here we are. We have sales. Obviously, you're going to track these sales. For some of the businesses out there, you again may want to break down the sales, not just have all sales under one category. For the CRA, they don't mind receiving just one amount. However, for you as the business owner, again, some details may be necessary to determine what areas of your sales are doing well and what areas are slumping, for example, and what you could do. All right, so again, the books and records are there to help you make good business decisions. So here's some of the expenses that you would commonly see in a business. Now, advertising, some of these things are self-explanatory, and we won't spend too much time on that. But bad debts is one that has been misunderstood many, many times. And for many businesses, prior to understanding bad debts, have actually just deleted or voided an invoice that was uncollectible. Now, that wouldn't be the proper method because there were expenses related to that job, for example, especially if, let's say, you were installing a furnace, and you incurred $3,000 to $4,000 in materials, and you bill the client $5,000, they don't pay you. You still had a furnace that you had to purchase. Perhaps you weren't able to repossess it, and therefore you're left. So deleting that invoice would also nullify the expense. Okay, so there's a principle. It's an international principle. It's called the matching principle between income and expense, especially in the service industry where and retail, where you actually have to purchase items or inventory to then have something to sell, right? So if you're selling whatever you're selling, you would normally see that expense on one side and then the sale on the other. They're matched together for the purpose of knowing what expense assisted you in earning that income. It goes back to the principle that I mentioned earlier. But a bad debt is an invoice that you've claimed as income. So perhaps in the sales, that bad debt of $1,000 is there because you did invoice it. It was collectible and you incurred expenses related to that job. However, you realize that perhaps by year end, you still have not collected it. You don't think you're able to collect it. So therefore you claim it here, that same 1,000, you write it down here. And so basically it's a wash from the sale to the bad debt. You've washed it out to zero. You've nullified it. However, the expense still exists and it will be in the other portions of this expense sheet. The next one, usually in a public setting, if we could see each other face to face, there would be a lot of questions on this next section, especially around memberships and subscriptions. This category is an allowable expense. However, you have to be careful. Be very careful as to what you include here. Because the expense, again, based on that principle we talked about earlier, must relate to earning income. Okay? So some may say, well, I have a golf membership and I do, find new clients on the golf course and all these kind of things. However, you are still enjoying the golf game. It's still a leisure for you. So the CRA does not allow these type of memberships and subscriptions because the membership or subscription must relate to what you do. So asking that question, who then would you think could claim a golf membership? And I've heard many answers out there say, well, obviously a golf pro, perhaps someone who sells golf paraphernalias and things. That would seem reasonable. And I'll give you another example. What about a subscription to, let's say, subscription to Home and Garden, Chatelaine, and Hot Rod Monthly? 3 different magazines that have absolutely nothing to do with my accounting business, but I'm telling you that they're eligible expenses. And if you responded, well, I must have a waiting room then for my clients, you're correct. So again, we could see that the purpose of that expense was directly to benefit the clients, not the owner. Okay, and of course, it leads to a sale. It doesn't seem too direct, but it does lead to a sale, that proper hospitality, if you have a waiting room, of course. Capital cost allowance, we're going to talk about this, but we're not going to go into detail because we could talk about hours and hours, spend quite a bit of time on this. However, the capital cost allowance is equipment and well, equipment could be including vehicles as well, that for the most part have a substantial cost to it. And so typically we think over $1,000, but for tools, it's over $500. But here's the key. The expected lifespan or use of this piece of equipment or tool is expected to last more than 12 months. If that is the case, then you would capitalize it. So capitalizing it, again, sounds very complicated, but what ends up happening is that instead of being able to expense the entire amount in 1 year, you are going to be depreciating it over time based on a percentage that the CRA and the Income Tax Act has determined. I'll give you a perfect example. For example, death share, it gets depreciated over 5 years at 20%. Okay, and your, of course, tax accountant would know that, and most sophisticated tax software as well will walk you through that calculation there. We're going to skip through a few that are not necessarily an issue, but we can stop on interest and bank costs. This is interest and bank cost on credit cards, lines of credits that are strictly used for the business. And I've heard from many new business owners that their banking institution does not want to issue them a credit card or a line of credit on this new business. And that's understandable. So what the good practice here would be to dedicate one credit card to the business until such time that the bank finally allows you to carry a credit card for the business itself. But the interest here needs to represent the interest on credit and used to buy and to pay for business expenses. Okay, so if you are tossing it around between personal use and business use, you'll have to determine the ratio of the expenses on a month-to-month basis that relate to the business to then prorate the interest cost. Okay, so all of these expenses here are considered directly and exclusively business use expenses. Legal, accounting, and professional fees, understandable. Maintenance and repairs could cover many different things. Could be maintenance and repairs to your office, or maintenance and repairs to equipment that you use to do your work, and so on and so forth. Management and administration fees is really the what used to be called miscellaneous, which we really don't want to use miscellaneous or other costs. We want to try to be clear and transparent as to what we're putting in this section. Management and administration fees could be, one of the questions were about casual labor. Well, casual labor would suggest that this person is not an integral part of what you are, what your business is, what industry you serve. And so, for example, when I moved my office from one location to another, I hired a couple of people at Strong Backs to help me move all my equipment there. That was casual labor. It had nothing to do with accounting, taxes, or managing the business for tax purposes and so on and so forth. They were considered casual labor. There was no limit as to how much I could pay them, but I would claim them as a subcontractor. Okay, so I would not have a responsibility as an employer to these people. So that's a good one to keep in mind there with regards to management and administration fees. Meals and entertainment. I think most of you by now know you're limited to 50% of what you actually spent. So when we say 50%, we mean 50% of the total bill. And so there's some that have said, well, you can't include the alcohol, you can't include this or that. So if your meal and entertainment tab was $100, you paid the $13, you got charged $13 for HST, and you added another $10 tip. Well, that was kind of cheap, but for this purpose today, we'll stick to that. So you had you had to pay $123 to the restaurant, and therefore $123 is an allowable expense at 50%. Okay, and that is simply the rule. The 50% is supposed to represent the fact that you could otherwise have eaten at home, for example, or entertained from home at a much lesser cost, which is a wise thing to consider to increase your profitability, is to control these expenses. However, if you do have this, the 50% not directly, but does represent the other people that you are entertaining. Okay, so it's again just a notional number of 50%. The motor vehicle expenses, we will stop and look at that in detail. So we'll skip it for now. Office expenses are fine. Here's the small tools, as I mentioned, that would not be capitalized, right? So they're under $500. Just include them here. You get to expense it, or as some say, write it off in that year. Okay, supplies, telephone, utilities, and so on and so forth. For many of you, the telephone and utilities will be your cell phone. The CRA does require that you have, if you're using your personal cell phone, they do require that you carry a log, so you keep your statements from your cell phone provider that would outline the business calls versus the personal calls. Because again, you have to determine the personal use and back that out. Okay, now if the personal use is less than 10%, the CRA doesn't care, as long as you can prove that it was 90% or more. Okay, and travel. I don't think we need to discuss that too much. In this category, we would want to include the meals related to this travel. And the reason for that is that typically the meals that you would be including here would be meals that you were otherwise alone. Whereas the meals that we discussed earlier, typically there would be 2 or more guests on that receipt. Therefore, the travel one would show perhaps only you. Okay, that would be the difference there. Okay, again, lay it out in such a way that makes sense to you. That's very important. Now, the balance sheet does intimidate quite a few people, and only because we don't really understand the purpose of this balance sheet and its structure. Hopefully you can see this on your computers. You'll notice that there's a few sections in here. There are a section at the top that you'll notice is the assets section. Okay, so remember that we were talking about the profit and loss identifies that the business is active, it's earning income, it's incurring expenses. But now we're looking at the balance sheet. We want to find out, is that business exercise actually viable? Okay, it's fine that they have sales, but are they being overcome by expenses and never really realizing a profit? Well, the profit or the balance sheet will identify this for you. Okay, so for example, the current assets will show, cash in the bank. It could be, petty cash and so on and so forth. Accounts receivable. So you've invoiced a bunch of people up to amount according to this at 10,000. You haven't received it yet, but it's an asset to you because eventually you will receive these amounts. And then the recoverable HST, for example, if you filed an HST return where you expect a refund, there it is. You haven't received it yet, but it's still an asset to you. You can depend on it. You know it's there. And then here you can see the breakdown in tangible assets. Here we have furniture and equipment and a vehicle or vehicles. Okay. If there was more than one vehicle, you would want to break them out separately. And intangible assets could be, for example, incorporation costs, a website as an intangible asset, things like that. They're treated a little bit differently and are depreciated over a much longer period of time. Okay, but we don't need to go into those details right now. But see, the balance sheet here shows now the assets of this company. The value of its assets is $62,500. Oh, well, that's great. But now we look at the liabilities, we can then determine how much of that $62,500 does the business owner actually own, right? So here's the key. Would you lend this person money? You can see the purpose here of this balance sheet and the profit and loss is to help a creditor extend credit to you. However, the creditor would look at this and say, well, you've got accounts payable of $5,000. You have a line of credit that's already up to $30,000. You've got bonus payable. Now that's probably to the shareholder or owner at $12,000. So we could back that out if we were going for credit extensions of any types. And then HST payable of $2,000, and then withholding tax from employees. Do you notice this here? It also has a long-term debt due to shareholder. So the shareholder obviously had to invest money into his own company to be able to start up. And here's how it's recognized: $13,000. So according to the bank or a creditor, they would say, the shareholder only has really about $13,000 to lose on this. You know, would the creditor extend any additional credit, you know, based on the fact that they might actually have a larger stakeholder in this company? You know, so again, this is what this balance sheet can do for you, right? So as you can see, the retained earnings was a loss right at the bottom here, was a loss in this year. So the retained earnings was a loss of $2,300. So, you know, so now we have a balanced sheet showing where the assets are, where the liabilities are. We can then determine what can we do to turn this around, to make this more viable. Because clearly, if I was to look at this balance sheet and determine its ability to pay, I would suggest no more than about $5,000. It's usually less than half of what the shareholder or the equity. Well, the equity right now is negative, but the shareholder has some skin in the game, so I'd be willing to, you know, lend up to perhaps 40% of that of this or to this company. Sorry. So as you can see, this is the balance sheet combined with the profit and loss statement. It allows you to determine what you're doing right, what could be improved, and what could be eliminated, for example, and perhaps addressing some of these, these debts, these accounts payable, lines of credit, right? So having a good, transparent record of what's going on will allow you to make good decisions. I guarantee you, having your books and records completed once a year are serving nobody but the taxman. They're not serving you in any way. So keep in mind that these books and records are a tool for you. So make the effort to try to structure them in such a way that is understandable to you and useful to you. And I do encourage you to include a bookkeeper to help you set it up. But imagine if you were to try to maintain these books and records on your own for a little while, you will have a new appreciation for what the bookkeeper can do for you. Typical bookkeeping, I would imagine, or not imagine, I know is roughly between $45 to $60 a month. You'll realize the value to that once you start doing your own bookkeeping. But I do encourage you to be involved in your bookkeeping, all right, so that you understand what's going on in your business and review it regularly to see what is going on. Okay, let's move ahead. There was some things here we want to break out. The accounts receivable, sorry. I'm just looking at my notes here. Oh, okay. I've already described this screen. Right, I want to look at this into more depth, especially the due to shareholder. Now, the due to shareholder in this case is an asset to the shareholder because this was a loan from the shareholder, not to the shareholder. Okay, so it's due to the shareholder, not from. So a shareholder can be considered to have borrowed money from the corporation interest-free. This was one of the questions, and again, we can't go into too many details, but it is important to note that it is an interest-free loan from the corporation, and because you are dealing with this corporation at non-arm's length, you are related to the owner, to the director, because you are one of the same. You're the director and shareholder. Obviously, there's a conflict, so it's allowable to have an interest-free loan. However, the CRA, the policy on the interest-free loan to shareholders is that it must either be paid back to the corporation or declared within 2 years of the loan being taken. So keep that in mind. Otherwise, you're looking at declaring 2% of the outstanding loan as interest, as an interest benefit on your personal income tax return. So you literally would be claiming interest earned on this loan, on this loan from the corporation. Okay, so be quite careful with the use of this shareholder-free, interest-free loans, as the CRA does keep a close eye on that category, as it could be abused. We're going to move ahead here. Before we go into this section here, I was hoping, because I figured we're about 15 minutes ahead. I probably rushed through it a little bit too much because I really do want to get into this section here as well, so that because there's quite a few anxious persons out there that I've met. They're my own clients, and they're so anxious about all of this, and so hopefully I'm going to alleviate some of those anxieties. But before I do so, I'm wondering if Jillian has been tracking the chat questions, if there are any questions here that I might be able to address before moving into the COVID. Jillian?
Hi, Alan. Yes, there haven't been any questions in the chat. Well, actually, no, let me see, there's, just opening it right now.
Okay.
I have one popped in. I can't see the full question. It's just coming through, but no specific questions. Oh, here, regarding a corporation, can someone do the HST alone, or do you need an accountant for that?
Good question. The tax system in Canada is designed, believe it or not, to be used by the taxpayer and to be able to report by the taxpayer. Using an accountant might ensure and peace of mind, for example. However, anyone can file an HST return. Again, it's really based on how well did you maintain those books and records, and therefore you would actually have to have backed out the HST and all your expenses, and so that you're able to claim that because that's a credit for you, and as well have backed out the HST in your sales to ensure that when you report, you have the HST collected and the HST paid through expenses. One minus the other determines what you owe, or perhaps a refund, especially in a startup. Was there any other questions, Jillian? You're muted, Jillian.
Thanks, Alan.
Yep.
Sorry, while we're on HST, there was a question that was posed prior in the registration questions. And that was around specifically what required documents, do you need to give an accountant then? If you were going to report on your HST or ask them to help for your HST, what required documents do you need to give them?
Okay. So as far as if you're planning on hiring a tax accountant to help you with your year end, for example, HST, corporate, or even small business, sole proprietorship, partnership, really it's having all the information that we've already discussed in the profit and loss as well as the balance sheet. So this will definitely assist the tax preparer to determine what allowable expenses and so on and so forth. It's important then too that your books and records, again, as I mentioned earlier, shows the HST collected through your sales, or that was collectible. You might not have collected it, but it was collectible, as well as the HST that was forming part of the expenses. So the net expense and net, the net sales and net expense would be exclusive of HST. And this basically is all an accountant would need.
Thanks, Alan. We had another question, an unrelated question in the chat, more specifically around the liabilities. So the question is, if there's a huge amount in the liabilities for shareholders, how does one address and control this on an ongoing basis?
So I wish I could understand the question a little bit better. Is that liability directly from the shareholder loan?
Yes, that's what it looks like the question is about.
Okay. So the due to shareholder is actually is an asset to the shareholder, right? It means you have skin in the game, you have control of the corporation because you have money that you've invested in this corporation. These are monies that you could otherwise withdraw from the corporation tax-free, because these are monies you invested after tax. So managing this, I think if I understand the question, what would be important here to ensure that these were legitimate contributions from shareholders is that you would keep a very detailed list of what was contributed and why. Because some of the shareholder account will include, for example, you brought in a vehicle and you brought in some tools and you brought in a laptop and some office supplies that you otherwise owned personally. So you would want to track these assets to prove that you did make these loans or you did share personal use equipment and such to the corporation. Hopefully that answers the question.
Great. And the next question we have is actually around COVID-related benefits, which I know you're going to get into more detail about. Yes. So I'll read the question, then I'll let you sort of decide if you want to move forward with the presentation or just address the question specifically.
Yeah.
But first, so the question is, for SERB income, where do sole proprietors include the income when filing their 2020 tax return? Okay.
Then we can address that now. And, we have quite a bit of time. So there are another business section that I will touch on after we're done with this COVID-related benefits. It's where to actually find help and find all these useful tools that were designed to help new business owners. So let's go into these SERB, CRB or the SERB. The CRA has issued T4As. So these are income statements. They're considered taxable, but a T4A is what you're going to receive. Whereas typically, if you were receiving employment insurance, you would receive a T4E. In this case, it's T4A. So it will be claimed as other income. It will be taxable on your tax return. And so again, the T4A, if you look at the T4A, it actually tells you which line to record that number on, okay? But if you're using the tax software, it will automatically populate the other income box of your T1 return. Many heard that the SERB you could be left with a massive tax bill at the end of the year. We've already prepared, our business has already prepared some 500-600 returns at this point. And I would say that 80% of the returns we prepared did include SERB income. And I would say the average was less than 10% was what the persons were owing due to the SERB. So if you received 14,000, which was the maximum, then you might have been subject to about $1,400 of it. Remember that the SERB was designed to help those at risk, significant risk. And so you can think of some of the industries that were significantly impacted by the lockdowns and restrictions and so on and so forth, would include, for example, especially the hospitality industry, where servers are already earning a very small minimum wage, one less than the average minimum wage, but depend on tips and so on and so forth to survive. These persons in that industry were significantly impacted, but were never expected to make $30,000, $40,000, $50,000 a year, not typically. And so the SERB was really designed to help such ones, right? So if you were working up until the SERB was issued, and then you went back to work, maybe three months later, and you're in this perhaps $60,000, $70,000, $80,000 tax bracket, well, the SERB wasn't technically designed to benefit you specifically. Not that you weren't eligible. I just want to make that clear. They made this to ensure that everyone who felt that they were at risk that would have some monies. However, you can imagine if at the end of the year your income is in the $80,000 tax bracket, well, you can look at, you might be paying back about 37 to 38% of whatever SERB you received. But again, as I said, for the majority of the recipients, it was less than 10%. And some of them was none. There was no tax at all, if that's all they actually earned in that year. So I had quite a few that had a little bit of CRB and the full SERB. Perhaps they were claiming about $16,000. The tax bill was about $100. Okay, because if we consider the non-refundable tax credits for 2020 tax year is a little over 13,000, which means you can earn 13,000 without paying a stitch of tax, both provincially or federally. So what are you left paying if all you're claiming is the 14,000? Well, it's tax on that 1,000, which would come out to about $140, $150. Okay, so you are reporting this on, like we mentioned before, it'll be reported to you on a T4A, and it will be recorded on your income tax return under other income. Now the CRB replaced the SERB, and the CRB was, rejigged, and they refined the restrictions so that it was strictly addressing those at risk. And so I'm not sure if too many people realize this, but if you applied for the SERB and received the SERB, and your total income, including the CRB and any other benefits that you received, exceeded 38,000, you will be required to pay 50 cents on every dollar over and above that 38,000, up to a maximum, of course, of the CRB that you received. So if you received a CRB of $8,000 and you're in the $80,000 tax bracket, well, of that $8,000, you'll be paying back $4,000. That's 50% of the CRB you received. And that is automatically recorded or calculated, if you're using any tax software, it's calculated as a social benefit repayment, like if it was old age security or employment insurance overpayments. And that's where it gets recorded. there's some good news here too. I just want to make sure that everyone is aware of the restrictions that were imposed on the CRB. But there is good news as well. The CRA has decided that if your total taxable income was less than $78,000 in 2020 and you have a tax debt owing, the CRA will allow you till April 2022 to repay this amount owing with no interest accrued. All right, so that's good news, especially for those who perhaps were in a higher tax bracket and now have a tax debt that they otherwise, wouldn't have planned for and didn't manage. So it's important here to know that you will have some time to be able to recover from that and pay that amount back. We'll come back to some of these and we'll discuss if there's any questions in the chat with regards to some of these benefits. But we'll talk to some of the business owners out there that benefited from the Canadian Emergency Business Account, the CEBA account. This was originally was the $40,000 interest-free loan that was repayable. 2/3 of it was repayable by December 31st, 2022. Okay, and then they extended another $20,000 on this amount. One thing that, and I'm not criticizing the government, I'm sure it's been very difficult to roll out all of these programs so quickly and efficiently and effectively, actually, and manage, of course, the health risk around all of this. So I'm not criticizing the government. However, I think that there's some information that should have been clear at the beginning when this account came out, because it's considered that when you took the loan, so let's say it's the $60,000 loan, 1/3 of it is forgivable. Therefore, that's $20,000 forgivable. But that $20,000 has to be claimed as income in your business. For corporations, there's a very specific line called that determines, that declares the government benefits you received, and that's where you would have to claim it. But here's the part that many of them didn't realize that received this loan, that income, that forgivable portion of it, must be declared in the year you received it, not in the year you repaid it. So that $20,000 for example, my year end is March 31st. So if I applied for the $60,000 loan, then my March 31st year end just came and went. I would have had to claim that $20,000 on my corporate return March 31st year end. Okay, even though I would only be expected to pay it at least 60% of it back in, or 2/3 of it back in December of 2022. Okay, so keep that in mind if you've accessed this CEBA account. Keep it in mind that all of these benefits, as the next bullet says, must be claimed as income, except for anything that has to be repaid. Okay, so the $40,000 part of that loan has to be repaid. Therefore, I don't claim it as income. Okay, so there was quite a few grants, wage subsidies. There was Ontario COVID relief benefits, to help pay for the PPEs and all these kind of things, rent relief, utility relief. So any of these reliefs that you received due to COVID, you must claim as income. And so if obviously you were a business, if you received these, then you're going to claim that as business income. Okay. Now I'd like to go back to these questions. Were there any questions that came up now due to this discussion of SERB?
Yeah, there were a couple of questions, and there's also some questions that were asked in advance. I know, business owners are really concerned about these programs, so there were quite a few. So we'll go back to SERB because there was a question about SERB. So if SERB income is included in your personal tax income, as you mentioned, you get a statement, can you claim expenses to offset that? For example, if you're, sole proprietor home-based business and you've got, home expenses or eligible home expenses, can you claim this against the SERB that you received?
Excellent question. It's an excellent question. I did answer it a bit in the questions and answer section that will be shared with you later. So you were expecting to run a business in 2020. We are all expecting to be doing something other than what we've been doing. So it stands to reason that you will have incurred expenses, whether or not you had any sales. So for example, if you bought a vehicle and so on and so forth, and you have to pay that loan back, and that vehicle was purchased for business use, then you would still be claiming the business use of that vehicle, even though you perhaps earned very little or none or no expenses. So yes, so what will happen is the SERB money will be claimed as other income. You will declare your business expenses even though there was no income, right? As we discussed earlier on that T2125, or something similar to the profit and loss that we reviewed earlier, and you will be showing a loss. And so that loss will be used to lower your actual income from SERB, right? Because they're all in the same column. And so you add them all up, including the losses, and the losses, if the loss was 2,000, then your taxable income at this point would be 12,000 instead of 14,000, right? So yes, you can claim operating expenses that you would generally incur if you had been operational. You were not operational due to COVID, not because you could not manage your business. Okay, so it's important that you know that the CRA understands, it makes sense that we're going to be claiming expenses against no income or very little income. Other questions, Jillian?
There's another question, this one about SEBA. So if you're a sole proprietor and did receive SEBA or the equivalent RRF funding, what do you use as sort of a record to claim? So one of the questions was a T-slip be issued, or was there a document, something like that, issued? Or how would you show this as a record to claim this on the taxes?
Well, there was no record really. It's a loan. When you applied for the loan, there were disclaimers and agreements that you had to sign digitally, and hopefully, as it's suggested on every one of those screens, to save it. But you could also get a copy from whichever banking institution you use to access these loans, to get a copy for your records. However, the forgivable portion, or that 1/3, simply gets claimed on your sole proprietorship business or income and expense statement. Okay, that's where this would be claimed.
And there is a follow-up question too. This is one of the questions that came up from some of our clients that received RRF. So there is a forgivable portion, but not every business owner is going to take that forgivable portion. They might need the full amount of the loan, in which case it converts to a 3-year term loan. So if you're claiming that forgivable portion now, and then come December 31st, 2022, you haven't repaid back the 2/3, so you actually don't qualify for the forgivable portion. What happens then to that treatment, since you claimed it in a prior year, but you actually didn't receive that income in the end?
Excellent question. So because in this case here, the amounts that you would be claiming back as an expense would be the payments you've made on a month-to-month basis. So if you've paid 1,000 or 12,000 down in that year, you could claim 12,000 as an expense, right? So the income was claimed in 2020, for example, and perhaps you paid back only 12,000 of it in 2022 or 2023. and of that 12,000 would become an expense. Okay.
So you're saying basically it'll work out in the end.
Yes. Yeah.
Great. So there's a question here about SERB income again. Can SERB income be used in calculating your RSP contribution limit?
No. So RSP limits are calculated based on earned income, and strictly remembering the word earned. So it's earned income. So SERB was not earned income. It was a gift, really, of sorts. And so therefore, no, it will not be used to calculate your RSP room.
Great. And we did have a question in advance sort of related to SERB and these other benefits. So some business owners and individuals have withdrawn money maybe from RSPs to supplement their income. And they've also then received the SERB program and income from these other government programs. Are there any suggestions you might have for tax saving tips on how you can minimize the taxes owing in this instance?
So it's too little too late, unfortunately. To give you the best tax tip was, do what you can in the first 60 days of 2021 to recontribute to the RSP to try to lower some of that taxable income. However, if you can include the SERB, the RSP income, and the CRB, the chances are you would be under 30,000, and so you're in the lowest tax bracket. It's the only consolation I can suggest is that you'll be taxed on the lower tax amount. There's really nothing after the fact that you could have done to tax plan on this one.
So that's all the questions that we have so far specific to the COVID related benefits. Did you want to move on to the other questions, or did you want to continue on with your presentation?
You know what, I'd like to go to the next slide, and we're going to look at where I find information and where I think that you as a business owner can navigate these sites and find so much great information to help you make the best decisions. So we'll go to this next slide, and so how about we just navigate here? But if you put Canada Business actually just Canada Business, sorry, in a search engine such as Google, you will come up with this website. Now, am I still sharing? Am I now sharing the website?
No, we're still on COVID related benefits.
Right.
There it is. Now it's come up.
Okay. Okay. So as you can see here, it's a Government of Canada website, but originally it was called the Business Gateway. I'm just giving you a little bit of background information to help you appreciate the people and the type of persons that were involved in creating this over 30 years ago. They were joint efforts between 3 universities in Canada, persons in the master's programs for economics, accounting, business management, and so on and so forth, statistical analysis. All of these things were, persons in the master's programs that helped put this together. So it's absolutely impressive. And now it's managed by the government, which is fine. I'm just going to move this out of the way so we can see here.
Alan, we're on the useful info slide. The website didn't come up, so you might have to stop sharing your screen for a minute and then share the screen where you have the website up.
Right. Okay. Okay, here we go. Thank you, Jillian. I'm so happy we've got all this resource behind us, keeping us streamlined. So here's the website that I was discussing with you earlier. I'm just going to move visually here. There's things in my way. Here we go. Okay. So we have this website here. Businesses and industry. It discusses absolutely every facet of a business and how to run businesses and so on and so forth. It has topical information. And so how about you as the new business owner, start right there. It's fantastic. Again, everything you can possibly think of will be here. So planning a business. So I will actually walk you through writing a business plan. I want to give you or recommend both Scotiabank and Royal Bank online have a business template that's I think is probably the best to use when you're creating a business plan. And you should be creating a business plan. By the way, this is part of what we're going to be doing this afternoon. How many would say it's a wise move to decide to go on a trip but not plan the trip? So you tell the kids, okay, tomorrow we're leaving on a trip. What's the first question that the kids are going to ask you? Or perhaps your spouse or your significant other. They're going to say, where are we going? How much is this going to cost? So no different than taking a trip, would we spend some time on planning it? We would spend time planning our business, determining how much is this going to cost me? How much time am I going to have to put into this? You know, when should I expect profit? First year, second year, third year, because you'll have to budget your operating expenses as well as your living expenses to meet the ability that this new business that you've created will be able to support. So it's very important that we plan it correctly. When I retired from the CRA in 2012, I knew I was going to just continue working somehow. And so I reopened a business with the purpose of helping businesses and taxes and take care of all of these matters. However, when I did my business plan and I started researching what was needed in Barrie and area, I realized that we needed more management companies. So my company does complete personal taxes, corporate tax, HST, payroll, and all these kind of things. However, I focus on helping to manage the business as well. So how did I find that out? Well, we'll come to that a little bit later, but it's basic statistics that was gathered over decades by the CRA, shared with Statistics Canada. Statistics Canada put it in a readable format, gave that to Industry Canada, and next thing you know, we've got access to these wonderful studies, and to be able to determine what business would do well in a certain area and what won't. You know, way too much competition, perhaps you wouldn't. Hopefully I'm not dashing anyone's dreams, but I'll give you a perfect example. If you do a statistical research on the hospitality industry in the city of Barrie, you will realize that we have more restaurants per capita than any other city in Canada of the same population. It's ridiculous. We have too many. So the chances are there will always be small restaurants failing, and it's not good planning, you know. However, if you look on Statistics Canada, and if we have a chance, we'll go to it, but I don't want to get into too much into that. But I want to whet your appetite to please go here and look at the resources that are available here and the information. Again, information is what helps you make a better decision. You know, I'm not sure where the adage comes from, but you know, a wise person learns from their mistakes, but a wiser person learns from other people's mistakes. So there's quite a bit of experiential knowledge and wisdom on these pages. So please navigate them and you know, spend some time here, and you'll find a lot of useful information. But planning a business, where to plan it. So if we go planning a business, you'll see all the different topics here. Developing your business idea. There's writing a business plan. What type of business will I be? Sole proprietor, partnership, or incorporation? buying an existing business, you know, or starting your own, different things like that. Choosing a location, again, statistically, it will help you to find the best area for your type of industry. And then there are the survival statistics. So you take some time, navigate this, because there is a lot of information here, surprisingly free. When I first started my business back in 1985, we used to do these new startup business analysis, and they were quite costly. You know, even back then, we were looking at $2,500 to $3,000 for a simple business plan with all the analysis behind it. Here, you can do all this analysis on your own by researching it right here. I'm going to go back. I want to look at a few more things here. But look at this here. Oops, let me back up one more. We didn't get the question today. It wasn't included in the list of questions, but I wanted to touch on HST. And when are you required to be registered for HST? So here, this page discusses every type of registration that you are required to do as a business. So for example, if you are going to operate as other than your own name, you know, so I can say Alan Lloyd Tax Services. Well, I don't have to register that. My name is already registered. It's already a legal name that I can use. But if I'm going to use something like Lloyd's Management Services or Lloyd's Tax Services, for example, I would have to register that, right? Because legally they need to associate these nicknames or also known as to a legal person, right? For liability purposes. Okay. So, but here, looking at these, the different topics that you would be required to register for. So again, choosing the type of registration, we're going to go to sole proprietor. It's the most typical. Okay. So in Ontario, of course, you have to register a master business license to use other than your legal name. Okay. So register by province. I think this was very well thought through and designed. So here's where you can go through and determine what you can do, what you have to do, how to register, and so on and so forth. So again, you cannot fail in understanding your tax obligations and your legal obligations. Okay. Here, we're talking more about the federal business number. So a lot of us know it as the GST number or the HST number. But that number actually, which is comprised of 9 numbers, will start with either a 1, 8, or a 7, and 9 numbers. So we'll just say 1, 2, 3, 4, 5, 6, 7, 8, 9. That's the business number that represents the business. But when you are required to then start collecting HST, because you exceeded that $30,000 annual threshold, then they're going to, the CRA will add an extension to it, an account for the HST purposes. And in this case, it'll be RT, so Roger Thomas 0001. That would form your HST business number. Okay, so if you need a payroll number, that number will stay the same. They will add an account to it, for example, RP. So let's just look at the HST here for a minute. So if I go here, it should discuss the HST right here. Here we go. Okay, so see here, again, now we're on the CRA website. We're no longer in that business gateway. Okay, so we choose HST, and I want to show you this specifically. It's so when okay, so many businesses are encouraged, if you're expecting to if you already know, because you've completed a business plan, that your first year you're going to see over 30,000 in gross sales, then register from day one, okay? That will give you the ability to claim back HST you've paid through expenses, so return cash flow, or otherwise tax dollars back to cash flow. What a great idea. So keep that in mind. So here it talks about not being a small supplier. Let's look at what is a small supplier. And here's the definition of it here. We're just going to read it together. A small supplier refers to a person whose revenue, along with the revenue of all persons associated with that person, from a worldwide taxable sales. So that means when we say persons associated, that would be either a corporation or a partnership. So it's the total sales of the actual entity, the business, not just that one person in that partnership. So if those, here it says taxable supplies worldwide, so you sell that anywhere in the world, was equal to or less than 30,000 in a calendar quarter or over the last 4 consecutive calendar quarters, you would not be required to register for an HST account. So the opposite would be then, in 1 quarter or in 4 consecutive calendar quarters, if you exceeded $30,000 in gross taxable sales, you would be required to register. And the time frame is you have 30 days after the quarter in which you exceeded the 30,000 to register. So they give you approximately 30 days, not approximately, exactly 30 days to register. I want to alleviate some concerns, as some believe that this could become retroactive. It's not retroactive if you caught it on time. So if, for example, January, February, March is a calendar quarter, and if by April 15th, you determine that, wow, look at that, I've exceeded 30,000 in sales over this last 4 calendar quarters, or this past quarter, you've got to the end of April to register, which means by May 1st, you're going to be considered a registrant and obligated to charge, collect, and remit the HST on every one of your sales from that day on. Okay, so keep that in mind, that's how that works. Okay, so again, you cannot fail if you have the information at your fingertips. And I'm telling you, I've done quite a bit of research on these websites, on this particular website, so that I'm able to then really hard sell it to you as a very good tool for you to use. Okay, applying for business permits and licensing is good, but look at this one here. Okay, getting business support, going through the, okay, going through this, especially innovation funding and support. So if you significantly improve the method, it may be covered under innovations and through funding and support. But understanding too what the creditors are expecting from you is explained here very carefully. Okay, so again, if you're going to reach out and go through the long process of trying to access credit, you know, and or startup money, or get someone to invest in your business, you want to do it the proper way. And these links here will help you to understand exactly what the creditor expects from you. Okay. At this point here, I would like to take a 10-minute break just to relax my voice for 10 minutes. And so if we could all be back here at 10:35, I would like to discuss more this website, and some of the questions that were asked, I think, are worth discussing here today. So we'll review those questions as well. So if we could all be back at 11:35, we'd really appreciate it. So we thank you for now. We'll see you in 10 minutes. Welcome back, everyone. Your host, Alan Lloyd here. I'm just looking at an answer that came from Mr. Fitzgerald. And you are correct, but it's not the CERB, but the CRB, the one that started in September. Okay, so the CERB will not be repayable unless, of course, the CRA was to determine that there was some fraud involved. So this applies to the CRB, not CERB, that started in March of 2020. Okay, I just want to make sure that we're all clear as to that. Okay. The T2125 that I was discussing earlier, I pulled it up here for our use so that we can go through some of the contentious issues and areas of this form. Is the personal use of your vehicle and the personal use of your home. So let's look at what the CRA has prepared as a template. Now, as a tax preparer, this is exactly the form that we use to submit to the CRA. So I'm going to scroll through here slowly. Okay, so this is the section here. Oops, sorry. The section here that would include all the business income that you had. So that's the gross sales. Now notice here it says including the GST. So here you would include the HST, but you're not going to be taxed on that because notice here you're going to be backing out the HST that you had to remit to the CRA, leaving you down here with the adjusted gross sales without HST. Okay, so that information will be very useful for tax preparer, accountant that you engage to prepare your 2020 income tax returns. Okay, so we'll go through here. I just want to point out here, this is other income. Now, this is not the other income having anything to do with SERB or any of these benefits, but this other income here that you would want to claim is, for example, a bad debt that you actually recovered. So perhaps we'll say in 2019, you claimed a bad debt, and then sometime in 2020, the person decided to pay you. Well, then you have to bring that back into income. So you would declare it here because it wasn't earned in 2020. And this is why they're using a separate line, just again, for transparency's sake. Okay, let's move on here. Notice right here, it also here will discuss a lot of what we've discussed today with regards to your obligations in reporting, either the CEBA account, the forgivable portion, or any other grants or benefits you received either from the province of Ontario or from the federal government. So this one here is, again, a lot more extensive than what I showed you earlier. Here would include, inventory purchases during the year. Typically, what is here is what is being sold, right? So inventory, if you're a confectionery store, then you are showing the inventory that came in that was sold. And then here again, the breakdown of all these expenses as we've already went through them. That's fine, but this section here contains the use of your home. Okay, so here in the use of your home, notice here it doesn't say to limit the amount here. It says total heat, total electricity, total insurance, maintenance, mortgage interest, only if you're a business, property taxes, and obviously there's other expenses, perhaps snow removal, some minor maintenance to the home can be claimed here as well. But notice here, the next line says personal use part of the business use of home expenses. This is where you would include the percentage that, or you would back out the percentage that was for personal use. Now, in my over 35 years of working with small businesses and the use of their home, I've seldom seen a legitimate more than 9 or 10% use of home for office purposes. All right, so if you've determined that you're at 20%, the chances are you will probably have a review from the CRA. Okay, unless, of course, let's take for example, a daycare running out of your home. Well, typically that's probably 50 to 60% of your home being used. That's understandable. All right, so the CRA knows based on the industry what is a reasonable amount to be claimed for the use of your home. Okay, so here you can see this. It helps you to see the breakdown of what you should be tracking for business purposes so that you can really benefit from the use of your home. Okay, so you want to be cautious, but of course, don't shoot yourself in the foot. If it's an eligible expense, then claim it, right? And claim the portion of the use of your home. I'm going to move ahead here to the use of your vehicle. So here it has a chart, helps you to see that if you look at the first number 1, kilometers you drove in the fiscal year or fiscal period that was part of earning business income. Well, that would necessitate some kind of log. Now, there's many telephone apps now or cell phone apps that would help you to do that. There's Google, there's MileIQ, there's many different apps that will help you track your travels for business purposes. But also, you'll notice number 2, it would require you then to also have an open odometer reading and a closing odometer reading. So for example, if it's your first year, well, whatever that first day of your business was, take a reading of your odometer. And then before going out on that New Year's Eve party, take another reading, if you can remember that. But soon after or before, a day or two ahead or after the fact, won't change the ratio all that much. Sorry about that. So again here, it does not differentiate the fuel and oil that you use for business, which means every time you fill your vehicle or you top up the oil or get oil changes and maintenance, you would include the total amount that you claim, that you paid, because there is no way of determining what liter of fuel was used for business and what liter of fuel was used personally. However, by using the ratio created up here, it will determine the percentage within, a reasonable range, what was used for business purposes. So notice here it has fuel, oil, interest. There's a chart below because the interest is limited to certain vehicles and certain value of vehicles. We'll look at that in a minute. So the insurance on your vehicle, license and registration, maintenance and repair, leasing, again, there's a chart below, and there's a special credit for zero emission vehicles. And then of course there'd be other expenses like perhaps, down here we have parking, but here we could have, for example, an automobile club membership, and or the 407 charges, again, you could include there. Okay, so it is important that you maintain a log, and it is a lot of work, and you probably have already determined this, that running a business is a lot of work. But the benefits that you will derive from it, the freedom that you have from it too, you'll appreciate. But it comes with a great deal of diligence with regards to paperwork. So if you can't manage it, please find someone who can help you manage this type of paperwork so that you can benefit in the best way possible by the deductions that the CRA allows for business purposes, for example. Okay. I'm not going to go through the interest on passenger vehicle or zero emission vehicles, but I do want to show you this section here, specifically this here. You notice here, there's a limit to the value of the vehicle that you can claim through a business. So the Income Tax Act is not trying to encourage someone to buy an $80,000 Cadillac Escalade to use in their business and be able to expense all of it. So in this case here, it limits you to $35,294 plus either the GST, PST, or HST in this case, in Canada or in Ontario. And then it gives you a limitation of 85% of this value. And that is the maximum you'll be able to claim and depreciate over time. So keep that in mind the next time you go ahead to either purchase a vehicle or lease a vehicle, that there is a limit as to what you can claim. All right. And you know this, I'm just going to take just a sideline for just a minute. But the purpose of you becoming self-employed was you were probably motivated because perhaps you were laid off or your job is no longer available. But for whatever reason that you're starting a small business, it is to be profitable, right? It's not to be able to write things off, because when you're writing things off, you're writing off your profit. Keep that in mind. So try to be as frugal as possible when purchasing anything, including your vehicle, that you are going to use for business purposes. So essentially, I'm suggesting that the reason for buying any piece of equipment or a vehicle is not because you can write it off. It's because you need it in your business. And you want to be able to do that as cost effectively as possible so that you can be profitable. So keep this in mind. The question of leasing over purchasing a vehicle, that question came up in the schedule of questions. And so I'd like to address that. Sorry. I'd like to address that with you now. So there's many factors to consider here. If you're buying the vehicle for the exclusive use of the business, and we'll say it's a half-ton truck, you know, two-door half-ton truck because you have to put lawnmowers and whatever. You have to carry freight back and forth or equipment back and forth from job site to job site. And it's not typically something you would use to go to the grocery store or take your significant other out for an evening whenever we are finished with this lockdown. But so this vehicle here would be exclusive use for the business. And it's a vehicle that you absolutely need. So should you purchase it and have a loan, or should you lease it? Well, either way, you're going to be able to expense a significant amount of that vehicle in any year that you purchase it or lease it. Some have the understanding that the lease is completely deductible, but remember, there are restrictions on that lease amount. Okay, so again, how to decide? Well, whether you purchase it or lease it for use in the business, I would suggest to you, if the vehicle is your business, I would recommend leasing it, not because of the tax benefit, because it's very similar to purchasing it with a loan and then depreciating it over time. The expense benefits are very, very similar. But as a lease, you have a guarantee that you have a vehicle that will always be available to you for your business. So I think that's a more important reason why you would want to consider either leasing over a purchase and loan. Okay, so there's that's my take on it for now. Yeah, as a corporation, I've had many questions with regards to that. Now there's this a restaurant who specializes in pizzas and those type of foods, and they requested an opinion from me with regards to buying a vehicle for the business. And I said, well, here's the question for you as and it wasn't, this business is incorporated. So I asked, the question was, will anyone be taking this vehicle home? And the answer was no. It was going to stay at the location of the store for the exclusive use of delivering the food. And therefore, I strongly urge them, then yes, purchase it through the corporation instead of personal. Okay. The reason why I asked that question is that if you are driving that vehicle home after business use, there will be a personal component, a benefit to it. It's called a standby charge. You can look that up on the CRA website, standby charge, and it'll explain to you what it is. But you are benefiting from a business use vehicle at maybe 10 to 15% of the time. And therefore, there will be a charge back to you. So basically, your tax accountant will have to calculate the taxable benefit on having that vehicle that is otherwise paid and maintained by the corporation. So you will have to claim a certain portion on your income tax return as a taxable benefit. So I recommend, if that's the case, purchase it personally, don't purchase it through the corporation, and then charge the business use back to the corporation. Because then you, as a shareholder director, will be able to receive whatever you charge the corporation, monies back from the corporation to cover the cost of that vehicle and more, and the depreciation of the vehicle, tax-free. You receive these monies tax-free. I think that's it's a wiser, more tax-effective way of using your vehicle in a business. Okay, so we had this section that I wanted to cover. We've gone through that. I'm wondering if there's any questions at this time. You know, we look, I'll see here, there's a chat. It says, does the area include the basement?
So the question is, does the area that you're going to deduct as a home office use expense, can you include the basement as only applied to above ground?
So as far as the policy governing this, the CRA is expecting that you're calculating the useful part of your home only, right? So if you're operating your home on the main floor, let's say it's a bungalow, then what part of that area is it occupying? If the basement is finished and you're using part of the basement, then what part of the basement is it occupying? What I've heard from some business owners is they have an office on the main floor, but they have a storage room in the basement. Well, then calculate what that occupies plus what occupies as an office over the total of area of the two levels. Again, that's reasonable, you know, but if the basement is not of any use to you as a business, it should not be included in the square footage of the home. So the CRA expects you to be calculating the square footage of the home as the finished useful part of the home. I do want to add to that. The taxable benefit of claiming the use of your home is significantly small compared to the benefit of not having to rent or lease a commercial space. You know, typically, I would suggest that the minimum would be at a cost of $6,000 to $8,000, easily as high as $18,000 to $20,000 a year to use a commercial space. And so this is why I suggest that to be, you know, be careful, you know, yielding when claiming the use of your home. Because these are expenses that otherwise would have been incurred by the home for the most part, except for perhaps a small amount of heating and hydro that might increase. But it's, again, I'm only speaking through experience, that it seldom has shown an impact on the house of more than 10%, right? So if your average household costs over a year, including mortgage interest, we'll say is anywhere between $15,000 to $20,000 a year, and the useful portion for business is 10%, well, that's $2,000. The $2,000 as a taxable benefit is really not $2,000. It's the tax related to that $2,000, which, depending on your tax bracket, could be as high as, we'll say, 40%. So you might be able to claim up to $800 as tax savings. So I don't know if it's, and this is where I suggest where you're being cautious, because the risk may not be worth the $800 that you're saving. So try to keep it reasonable and representative of the true use of the business in your home. Okay, if you can prove the area that is being used exclusively for the business, then any audit or review will find it allowable as well. So if you can prove it to yourself, you can prove it to the CRA, great. That's the way I look at it there. Is there any other questions out there?
That's all we have for now. We do have a couple that we could wrap up. I want to be cognizant of time. We're getting close to the end of the webinar, but there were a couple that came through in the advanced registration.
Yep.
And one was specific around, you mentioned the hiring a bookkeeper. And so they wanted to know, when you hired a bookkeeper, what was some of the things you could identify as potential issues or areas of concern that you should look out for as a business owner when you use the services of a bookkeeper that would alert you to any problems?
Okay, good question. Very good question. So I've worked with many bookkeepers over this few decades, and what I found was an area of concern was a bookkeeper that was not modest, so didn't stay within their wheelhouse of expertise. They might have a lot of experience, however, a bookkeeper does just that, organizes, makes your financials, or puts together your financials in such a manner that you can read them and use them to make management decisions. So you have to be careful. What I've noticed, and I've received from many clients as well, is bookkeepers that give tax advice, financial advice, where they're not supposed to. I have to add to that as an accountant, I cannot give you financial advice either. That has to come from a financial planner. So we are restricted in our industry as to what we can provide for you. Second of all, with regards to a bookkeeper and anyone who works for you, again, they're working for you, and therefore they should be able to answer to you. And if you have questions and you have concerns, and they're not addressing these questions and concerns, and perhaps are not providing you with the information in a timely fashion, that is an area of concern. So I've always suggested to any new business owner, talk to other business owners that you trust and find out who they're using and why they're using this accountant or this bookkeeper or that tax preparer. Why? And if those qualities are what you're looking for and that person is satisfied, the chances are you will be too.
Great, thanks, Alan. I think that we covered all the questions that were raised in advance of the registration and through the chat today. So I know it's close, it's 11:59, close to the noon that we wanted to wrap up. I don't know if you had any final comments or recommendations for anybody, otherwise we'll move to wrap up.
I do want my last closing remark really relates directly to COVID and the situation that we're all in. I remember my economics teacher saying this my first year at university. He says, how we react to things is what determines the end, what determines the results. So persist, keep going, and don't be afraid to pivot. Don't become complacent. and thinking that this is the way I've done it for years and I'm going to continue like this. Businesses that are pivoting to adjust and adapt to these situations are thriving and are doing well, and you will too. Thank you so much. It's been a pleasure.
Great, and thank you, Alan, for all your expertise and advice. I just also I want to say thank you very much for the presentation and informative session, and thank you to all the participants for attending today. This webinar is part of the Ask an Expert series that has seen such topics as workplace health and safety and supporting mental health in the workplace, and there are many other recorded webinars that you can access at edo.simco.ca. So stay tuned for more information about upcoming sessions. We'll also be sending out a survey by email with the recording of the session after the event. So please watch out for that email and let us know what you thought, and also provide some feedback on any additional webinars you would like covered. And once again, I do want to thank Alan for taking the time out of his busy schedule. I know this is an extremely busy time for accountants and tax advisors, and for sharing your knowledge of all the wealth of knowledge that you've built up over the past few years, or many years. So thank you for your presentation. Thank you to Simcoe County for hosting this event. Thank you for Jamie and Karen in the background, and all our supporting partners. We wish everyone a fantastic rest of the day and week. Take care and stay safe. Thank you.